Good morning, good afternoon, and good evening to everyone joining us from across 17 countries today to our webinar about financing the future of clean fleets. I'm Liliana Pereira, Senior Vice President at the Steer, based in our Washington, D.C. office. We can have our intro slides, please. At Steer, let's go to the next one. At the Steer, we've helped clients close more than $150 billion in transactions across global markets in recent years. And we've been deeply involved in major low-emission fleet deals globally. What makes us effective is our work as integrated teams across regions. And you will see that approach reflected in our panel today and in our audience that we have hundreds of people logging to our webinar today. What we see today are public and private organizations facing very real trade-offs, meeting strategic goals, ensuring reliability, and achieving financial sustainability. And technology alone won't get us there. So any transition requires new financial models, new partnerships, and new investment strategies. So today's conversation is about reality. We are unpacking practical financing structures and sharing lessons learned from key people involved in financial decisions. So let me introduce our panel. First, I'm going to introduce Jeff. Let's go to our next slide. Jeff Matthews joined us today. He brings deep investment banking and origination expertise across energy, power, and climate technology. Jeff is a managing director and head of origination within Principal Asset Management's private infrastructure platform. Prior to joining Principal, Jeff spent 12 years at Barclays as managing director. And earlier, he was part of the energy and infrastructure banking teams at Nomura, BMO Capital Markets, and Scotiabank. So thank you, Jeff, for being with us today. Then Dr. Julia Covade, Head of Strategy, Global Structured Finance at SMBC Bank International. Julia is based in London, and her work covers Europe, the Middle East, and Africa. And she has over 15 years of industry experience in social infrastructure and transportation transactions. Julia holds a PhD in economics. Thank you, Julia, for being with us today. And Kartik Gopal is the global EV industry specialist at the International Finance Corporation, IFC, with more than 28 years of C-suite and international experience across 14 countries. Kartik has served as the industry specialist for over 1.7 billion in EV investments to date. And Kartik pioneered India's first battery leasing program, advanced EV adoption across new commercial fleet segments, and led the product planning behind India's best-selling electric three-wheeler, while continuing to shape emerging opportunities in electric trucks and buses. So we are very, very honored to have you with us today. Thank you for your time and your insights during today's discussion. Let's go to the next one. So today's practicalities, thank you for all of you joining us in this streaming platform. This would be a conversation with all our panelists with a list of subjects that we thought may be of interest for you in the audience, and the recording will be available after the session. Please join the conversation as we go. You're invited to ask the questions as the panel evolves. You don't need to wait until the end, and our team will be reviewing them, and we will try to cover as many as we can. And to our panelists, we have a packed agenda, so I may jump occasionally to keep us on track and try and cover as much ground as we can during the next hour. So what's our motivation for this session? And let's have a few reflections about the market. So we have around 20,000 EV buses in Europe, around 140,000 vans, and a nascent number of EV trucks in operation. In countries like India, we have more than 10,000 e-buses in operation, leading micromobility adoption. In the US, we have roughly 6,000 electric buses. We have a substantial fleet of school buses in operation, roughly 2,000 EV trucks in operation, numerous van fleets, and recent funding for natural gas and hybrids. And Canada is growing its bus fleet and nascent EV truck play as well. And in Latin America, we have about 7,000 buses in operation, trending to triple that number in the coming years. We have e-scooters and e-bikes popping up, and e-truck usage is very modest due to a number of reasons. Natural gas fuel is still a major low-emission fleet segment in Asia and Latin Americas, and as I mentioned, it was subject to funding in the US recently. And yet, when we look at the deal flow, we see using data from Infralogic that monitors and reports transactions. During 2025, we saw around 46 transactions closing in the low emission sector, and particularly in the EV sector, with around 5.3 billion in those deals reaching financial closed in 2025, and a good amount of those deals related to charging infrastructure. About 10 of them related to fleets, reaching about $2 billion in transaction size. And we thought these numbers are important in terms of what is the size of the sector and all the fleets that are already operating, and then the kind of outlook that we see in the next 3 to 5 years and the growth that is expected in these different segments, against perhaps the very modest deal flow that we saw during last year. And even in those stages, we think, or more so in those stages, we think it's very relevant to have these conversations, understand what's going on, and bring the perspective of our panelists. So with this context, let's start the conversation, and let's start talking with their panelists and seeing their views about that. So first, let's cover the macro view, and I'll go first to Kartik. Kartik, where do you see clean fleets, and where do they stand currently in the financing decisions of IFC? And how is that position expected to change over the next 1 to 3 years?
First of all, thank you so much for having me here. It's a pleasure to be a part of this panel and represent the view from the emerging market world of financing for electric mobility. So broadly speaking, today we have already, as part of our IFC strategy, we identified public transport electrification and commercial fleets as two strategic focus areas for us for electrification, for investments in electrification. And within this, we have built up a reasonable portfolio of investments. So there is a significant amount of investments that's gone into the electric bus space, primarily in India, Chile, and we are looking at a few other markets, and also in the electric trucking space. So again, bit of India, Latin America. So these are two prominent spaces. We also, because in the global south, two-wheelers are also an important part of the transport landscape. So there are, hopefully in the coming weeks, months, we would be able to announce some of our investments in the African continent in the two-wheeler space as well. So I think it's a very diverse portfolio of investments, also diverse kinds of instruments. We have used equity, we have provided debt, we have done convertibles, mezzanine kind of capital investments, SLFs. So I think it's also both from diversity of geography, diversity of vehicle segments, and diversity of instruments that's been used. We're starting to pick up our own experience in this space in a very tangible way. Thank you.
Thank you. Thank you so much, Kartik, for that introduction. And then I just wanted to check if the slides about introducing IFC and Yuval would be good at this point, or if they have been streamed already.
I think we can skip that. Broadly, the message was that, I think just one other message, if I may leave with the audience, that we are a part of the World Bank Group, the entity that focuses on the private sector. So there are institutions within the World Bank Group, that IBRD and IDA, which focus on public sector investments. Our remit is to focus entirely on private sector investments. So that's therefore we are as aligned towards risk and return as any other private institution would be. That's how we function. So just wanted to draw that distinction. But we come across with, like you would have seen now with my answer, that we come across with a wide toolkit of instruments to work with. It's not just equity, it's equity, debt, mezzanine, and so on. Thank you.
Thank you, Kartik. And through the conversation, we are going to go to those instruments and the transactions that you have seen and are supporting as part of IFC. So a lot to unpack from that experience and the role of the World Bank and the IFC. So let's go to Jeff now. Jeff, from the deals that you're seeing today, let's talk about fleet segments, what you see remains financeable in the market at the moment, which fleet segments, perhaps if you want to touch on that, have become more challenging. And also it'd be great to talk, if you can comment on deal sizes, investor return expectations.
Sure, absolutely. And thank you very much for having me on the webinar. And hello to everyone listening and to my panelists. Greatly appreciate the opportunity. So just for background, I'm with Principal Asset Management. Principal is a life insurance company in the United States, and I lead origination and managing director on our private infrastructure investments team, which includes beyond energy, power, and digital. It includes transportation and mobility. So we are a sort of a loan investor and a long-term note investor as well, sort of on the private credit spectrum for background. In the fleet segments, sort of what we do from a credit perspective is really zero in on sort of the underlying asset quality. And the first thing we look at is the existence or lack of contracts in place and the strength of the customers in place. If the contracts can be sort of fixed pay lease structures, which is sort of the most most low risk credit spectrum element, it's often much more utilization risk based, and you focus in on the connections per day, the average kilowatt per connection, and whether or not there's some sort of moat of exclusivity. And I think the moat is very important, and vis-a-vis who the customers are. So those are the sort of the primary levers that we evaluate fleet and mobility charging opportunities. I'd say, I think your question was, what are the return expectations and deal sizes? I think we've seen deal sizes from 150 million to 350 million on the most part. I'm avoiding currency there, but it's been in euros, pound sterling, and US dollar from our experience, in particular to us. We've seen deals that have been rated investment grade. We've seen most deals be unrated term loans structures, sort of mini perms. I think in those mini perms, they're structured as what I would call cuspy investment grade pricing. I think there are also more high, some high yield structures, but I think how you get to those sort of return targets and cost of capital targets has a lot to do with scale. What's your borrowing base of installed assets versus pipeline and growth funding? So the best deals we've seen, for example, like Zenobē, are in that 300 plus million financing that is largely for existing installed base with some capex facilities for growth and pipeline. And then there's the inverse, which tend to be a little bit more high yield. But last statement is I do think the investor types for credit are largely banks, but increasingly institutions like ours.
Thanks, Jeff. And I think that point of underlying asset quality and then unlocking scale, we're going to talk about that a little later, but you're starting to point that as a very important matter. I think the deal size, that between 150, 300 million, regardless of currency, is also a very good point to come back to. So let's go to Julia. And Julia, on the regions where you operate, let's talk also about certain fleet types. I know you've been also involved in charging infrastructure, fleet as a service, charging as a service. What can you tell us about those fleet types that are being kind of more successful in kind of going for financing and reaching financial close?
Thanks, Ilyana. And yeah, good morning, good afternoon, good evening to the audience. And thanks for having me on this panel. It's a great opportunity. I work for SMBC Bank International, a Japanese bank. And first of all, to kickstart with, before going probably down in saying what type of deals we see, transportation sector is an important sector, I think, for most financial institutions, and that we have looked at, and it actually has been quite interesting to see how over the last couple of years, so 5-6 years, actually the focus has shifted. And I think you, Liliana, mentioned out quite correctly at the beginning. The focus moved quite quickly to CO2 emissions and to fleet changes or to changing of transportation modes. And initially, a lot of focus was on charging infrastructure. I think the sector was quite focused on saying we need charging infrastructure before we can actually expect any vehicles to be on the roads. It has not grown as quickly and as well as probably most have initially thought. So the focus was initially, or the growth expectations were quite high. It has been a bit slower than everyone would have expected, and we can discuss about the reasons later. EV fleets followed, I think, quite a bit later than the charging infrastructure. So we have seen fleet deals following slightly later. They are still not as frequent, I would say, as we would say on the charging infrastructure. And as outlined by Jeff and Kartik, it really depends on what we see on deals, which are the counterparts. And in certain sectors, and again, it was highlighted earlier, buses, we see much faster changes in cities and else than we probably would see on the trucks, given also probably they link more to the charging structure, which they need for longer distance and vans as well. So in certain areas, I would say on the EV fleets, you see a much faster pace. And I would say in the cities, we will see much faster pace, and we have already seen it. Then we probably see with the long distance requirements of fleets.
That's great. Thank you, Julia. And I want to bring Kartik to the conversation in terms of contrast, right? There is this kind of charging infrastructure first and then fleets, as because kind of the enablers need to be ready. But then, Kartik, you probably have seen the opposite trend, or something that is compares differently in the geographies where you operate. So what can you tell us about that reflection, and also kind of going deeper in what are the transactions that you see, how they are likely to going to evolve in the geographies of your focus?
Sure. So in most of the global south, the markets where we operate in, the primary value proposition of electrification comes from whether it can provide a better return compared to deploying an ICE equivalent vehicle. So what I mean by that is that in commercial use cases where an EV is used for many more kilometers a day compared to what a private individual will use it, in those cases, you tend to see a faster payback with an electric vehicle compared to an ICE vehicle. And that then leads to a potential profitable venture in providing fleet as a service or in running buses. So that's been the framing, the broad outline of opportunities that we have been pursuing and looking at and developing as well. So within that framing today, the bus sector came up in a big way in India and in Chile before that, so, and also in Colombia, but Colombia we have not invested yet. So in these markets, the buses run a lot of kilometers. If you structure the contracts well, there is a potential opportunity to fund those projects, and they are now moving to a cross-cost contract, unbundled kind of model. So those have helped. Then in the trucking space, it's been very specific niches. So we have, for example, operations which run on fixed routes and schedules. And by tweaking the contract quality, by extending the contract tenors and other kinds of parameters, we are able to get to better contracting structures, which then give the comfort to be able to lend to those kinds of operations. So those are the kinds of operations. Now, specific to this whole nuance of charging versus charging or the vehicle operation, in the fleet case, it becomes important that the two are developed, co-developed, because you need the charging infrastructure to deploy the fleet. So they are almost done simultaneously with a very limited gap. But more importantly, there is an assured usage of the charging infrastructure that you're deploying, which then feeds into the overall returns profile of the project as a whole that you're developing. So that's what we look at as the overall returns of the project and how bankable is that. And based on that, provide the kind of financial instrument or structuring of it that we can do. Thanks.
That's great. Thanks, Kartik. And at the end, I hope we can get to more questions about trucks and about, getting deeper into that kind of fixed routes scheme that you're describing and into which geographies we see that developing well and any lessons learned from that to share with our audience today. Let's go then one level down in terms of structure. So we have talked about types of fleets. We have talked about kind of charging and fleets and that play and perhaps order or going in tandem, and about the quality of the assets and the value proposition as the first driver of successfully going to the market and kind of deploying these fleets. So in terms of the structures, perhaps I go first to Julia. Let's talk about what financing structures you are seeing are being, better perceived by the market and by the bank recently. Leases, battery as a service, etc. Others that have been introduced by each of you in the initial introductions. And how do you think those structures may evolve in the coming years?
Thanks, Liliana. And as you outline, I think the main structures we see also Kartik and Jeff mentioned is really, we see quite a lot of these batteries as a service or a lot of lease structures and similar. We don't see so many standalone projects where you upfront finance the whole fleet as such. It's given the huge amount of costs. I think what we will see a lot in these, and Kartik focused on this on the emerging markets, but actually it's pretty much the same in other markets too, is to see what else is in these transactions. So we see a lot of initially having the fleet or the financing of the fleet itself, but really ignoring what with the batteries you can do on top of it. So we see a lot of the involvement of co-locations and battery charging and probably feeding back into the grid when they are not needed. So I think this is a trend which we will see much more going forward. So what we will actually see, which I tried to outline earlier, probably not as well as I should have, is we will see a bit of a merge of transport sector, energy sector, which in the past probably was more separate, and we see probably with other sectors who knows in the future AI and else might come in as well, given to see these evolving, which makes it potentially financing wise more difficult, because as a lender we usually like proven technologies. We like to know exactly what is across the corner, and having these technologies will potentially take a bit more time, therefore for traditional lenders, if I can call it like this, to be comfortable with transactions. But we have indeed, and I think we mentioned, and it's so therefore not a secret, Zenobi and things. So these type of transactions we have seen, they are pretty much well acknowledged in the market of working of an else. I think one of the constraints that initially also was in this sector, that was the awareness, or not awareness, really more the forecast of whether batteries would really do what they were claiming to do. And I think this concern pretty much has been put to bed since the initial days of financing of EV fleets. I think so. It will really be focused more of how viable are the various projects, and there will be not one project or one product fits all in each region. Each transaction will be slightly different.
Thanks, Vivian. There is this point of optimizing, as much as possible, deploying like many users, and at the same time, how complex the project becomes, and the uncertainty that it creates. So, Jeff, what is your view on that, on kind of the hard asset ownership versus more kind of these service-related lease structures, asset-light structures? What is your view on that?
Oh, just my reaction, because I agree with everything that was just discussed. Just reaction to that, I think we both referenced the Zenobi transaction. Not to isolate anything, but I think it helped to have good sponsorship. That's obviously a good signal, because sort of addressing partially the technology risk. There's also scale up risk here. A lot of this is growth capex that has multiples of the installed asset base. That was sort of the initial borrowing base, and you have to get creative in how you structure that sort of warehouse facility that you're lending against a de-risked borrowing base as opposed to a speculative pipeline. And the context of that it helps to have a deep-pocketed sponsor. It's not necessary per se, but in the context of trying to do more growth-oriented debt financing, having a deep-pocketed sponsor is a factor. I just would point out. You're asking about sort of collateral packages and business models that get sort of infrastructure investors like me, like us, more interested. I think there's no correct answer. I think generally, all things considered, everyone wants hard assets with collateral value for downside protection. You want to know what the collateral value of your hard assets are. But if you have a energy as a service recurring revenue stream that is better to be contracted, best to be contracted, but good to be predictable, like with the advice of Steer, for example, that's fine too. If you have sort of a more of a service-oriented but predictable energy as a service cash flow stream. But if you don't, if you're more focused, if you have a little bit more utilization risk or volume risk inherent, then you absolutely sort of need the collateral value of an asset-heavy portfolio to get infrastructure lenders to the table, I think.
So you have to have one of them at least to
Yeah,
be.
you sort of have to have recurring revenues or a mix of volume risk with hard assets.
Yeah, definitely. Thank you for that. And Kartik, with that emerging markets perspective, let's talk about structures that you have seen, what the structures are providing to be more effective, and also kind of and is important also in the geographies where you operate, that are producing that scale element. So can you share with us about that?
Sure. So I think one of the advantages that IFC brings is its ability to work with multiple kinds of instruments. And more importantly, we also work with companies that we like to provide them advisory support through non-dilutive capital to help them get to a point where we can eventually invest. So, for example, in India, we have worked with this company called Transvolt. We are engaged with them for almost more than 2 years, came up to a point where we invested equity. But the long-term goal is that as they scale their operations, we would also be able to both provide debt from ourselves, but also be able to mobilize similarly for equity as well. So that's one kind of a pathway that we take. There is another pathway where we have invested convertibles, so which means that you are seeing that there is a certain kind of a potential upside that the company may have, and they also prefer some kind of a fixed return instrument and plus some kind of upside sharing. So there is tremendous flexibility in the kind of intervention that we can bring in. But to be very honest, I think there is the instrument side of it, and there's also the kind of investment or the company that we are investing into, and there's variation in that. So there, for example, Transport was a quote unquote startup, but an asset co, a company that would own assets and deploy fleet as a service. We have invested in a fund that has invested in setting up an asset co. So we have gone one step ahead and been an LP in a PE fund that has then invested in setting up an asset co. That's in Brazil with the Patria Fund and Evolution Mobility. We have done sustainability linked loans with Element Fleet in Mexico, which was purely based on their move towards also including, they are a leasing company, one of the world's largest, amongst the top 3 or 4. They have operations in Mexico, needed local currency financing, and we structured a way by which their growth path towards adopting and financing EV trucks could then get a loan from us based on, of course, they have a very strong balance sheet. So I think the kind of instrument also depends on who the investee is and what their strengths are, and what's the nature of risks that's coming in the context of the operations that they are undertaking. So it's a combination of both that determines this. Thanks.
Thanks, Kartik. And we are gonna talk a little bit more about kind of unlocking that scale and the instruments that IFC provides. But you have hinted about kind of that ability or the possibility of IFC to kind of contribute. I don't know if you still use this term, but upstream, helping to develop the deal to kind of a point where it has this scale and then is able to deploy more financing, and then growth and scale of the fleet deployment is as a result possible.
That's exactly what I was referring to as the advisory support, which comes with non-dilutive contribution. So you're not actually taking away anything from the company, but providing them some kind of a support, what we call upstream advisory support, where they also contribute. We bring in our part, and then we get them to a point where we can invest in them. And I think that's where I should acknowledge that Steer has been an integral part of a lot of such advisory projects where we have worked either at a sector level or at a company level. So really pleased and honored for that. Thank you.
Thanks, Kartik. Yeah, it's been, I'd say, very interesting to work in all these geographies and to see how things are developing. And then I think that's a very good segue about what could be the drivers to unlock a scale, and that we are talking about as a very important element, either from that perspective of, what are the underlying assets that are going to support these transactions, or what is that kind of revenue stream that would be kind of supporting the transaction and investment. So Jeff, with you, let's start that conversation in terms of what could be kind of those catalysts that could unlock that kind of material, larger private capital flows into clean fleets and in the enabling infrastructure, because we have talked about that play needing to go hand in hand.
Well, I think the answer is extremely different if we're talking about equity funding versus credit funding.
Correct. Yeah.
I think I'll just say I do think that there's probably tremendous upside there is tremendous upside likely over the long term for equity, whereas with credit it might be limited in its ability to be growth capital. And this is certainly a network effect situation that's sort of been alluded to already. But sort of your question is sort of how do we get it to scale up and get the right cost of capital?
Yes.
I think the themes we've been talking about, I think sort of the business model, the scale, sort of the recurring revenue and/or customer base and/or contracts associated, the hard asset collateral versus sort of managed services that are not subject to recurring revenue, that getting that mix right. And then going back to, again, I've already said it, but scale. I think once you have a moat around a business and you have a scale with a customer base that is reliable, then you can really extrapolate some predictable cash flows, again, with the help of third-party experts. And that's where you're going to get scale. That's where you're going to get larger financings, is those scaled businesses, those de-risk businesses, those business with customer track records, and the right business models, operational history. The earlier stage, less mature companies, I think, will get, lesser credits, loan to value, so to speak. And then the more mature will get higher. In terms of driving cost of capital, it's sort of the same theme, where the more mature, if sized correctly, you can get to sort of cuspy investment grade, sort of, I'm using United States rates, but SOFR plus, the mid 200s type of range. Or you can, if you're not there, there's the below investment grade market, which would be more like that plus 350, 400. That might look more that might be more helpful capital for more growth oriented businesses. So I think that's the same thing we've been talking about, is the same themes that would get to larger credit financings and better cost of capital.
Exactly, and to scale. And there is also kind of, I think, a cost reality that, I was talking 5 years ago about this and how to unlock scale and all that, versus where we are now, in what Julie was mentioning, kind of the batteries and the risks associated with that, and kind of the cost of technology that has been decreasing, could be another aspect that would be great to talk about. And with that, Julia, either on the cost side or on regulation, industry standards, what do you think could be those elements that could also kind of help? I imagine you kind of have similar thoughts to Jeff in terms of the asset itself or the project itself and what conditions it should have. But in terms of that underlying environment, and regulatory or industry standards that I was mentioning, what do you see could be important, or a trend or an implementation that could continue help unlocking that scale?
Apologies, was a question for me? I had for
Yes.
a few minutes lost my connections. I couldn't hear anything.
No worries, Julia.
I just got
That
back
can
in,
happen.
my Wi-Fi
Yeah.
just stopped working. Apologies.
No worries. I'll share the question again. So I was talking about regulation and industry standards, Julia. There has been a lot of activity in Europe, but still, if there is anything that you see, in addition to what I was mentioning, Jeff was touching more about the conditions of the asset of the project itself. What do you see on the underlying environment, regulatory or industry standard that could help unlocking that scale?
First of all, I agree with everything Jeff said. Scale always comes up, I think, no matter whether you're on the debt side or on the equity side. I think from a regulatory perspective, what we have seen in the sector is quite often as an obstacle, the misalignment of incentives or of regulations. So you had certain incentives coming in, and then suddenly they are being stopped or they are being scaled back. So in a lot of business cases are usually when they come into play, these, for example, if you have an EV fleet and we are knowing we are exempt from certain taxations, road usage or else, and the business case is based on that, and these regulations for whatever reason are being removed shortly afterwards, again, it has an impact on the business case the project has had, and this is not helpful. I think what also will help a lot these days is, as kind of alluding to earlier, it's not just the scale of the fleet itself, but also that stability linking to the charging element, which is quite often forgotten, because unless we indeed have that ability to charge and have their either contracts and know what the price is, or have that ability to really put that into consideration, it makes it really difficult for certain type of projects. Obviously, not every single project in itself. I think another element that also Jeff alluded to, it's not so much a regulation in itself as such, but as an industry, the usage and the focus on efficiency, on how these fleets are used, how charging is being used, how therefore electricity costs are being incurred or not incurred, and therefore also impact on life of batteries if they are not used to the capacity and incorrectly or charged. This plays a huge role. And it's, as I said, it's not a regulatory element as such, but it is a huge element that will drive and unlock the scale, because that is so therefore lenders will want warranties for batteries or else to ensure that, and Jeff mentioned as well, looking at if there's a residual value aspect. So if you have a fund transaction where there's a refinancing risk, you want to understand really what is actually the value of, for example, the bus fleet at the end to really assess what's going on. And I think regulators really need to be more focused and more straightforward. We have seen in the EV sector a lot of back and forth, which is not helpful. The environmental targets really need to be upheld that have been set, and that will drive these sectors and the scale that we are all looking for.
If I may, I think
Of course, yeah.
this point that Julia's speaking to, it's just an interesting to reflect on how different the U.S. is right now to Europe and elsewhere, and hopefully that's a short-term thing. But yeah, this having these policies, whatever the policies are, in place for a prolonged long-term period of time would really unlock a lot of capital.
Yeah, of course. I mean, there is a point of certainty and uncertainty, but also I think, Julia, you were touching on perhaps a straightforward or the consideration on how much certain business models could rely on those incentives, and the work that would need to continue being done in kind of preparing those deals and those projects in a way that that dependency is perhaps, I mean, is enabling rather than so much determining of the success of the deals. So I think that's I'm putting my spice to it, but it was a really interesting point. And Kartik, either on the regulatory element, industry standard, or kind of ecosystem gaps that you would see that could unlock a scale. We have talked a little bit about charging, like further energy kind of developments that need to be in place for that scale to be supported. So what are your comments about the main ingredients to that unlocking a scale? And this question could give for a full webinar, but what would be the highlights?
Yeah. No, everything that has been said so far by Jeff and Julia are fully aligned with that. There is one other thing which I may highlight, which is somewhat more unique maybe to emerging markets, and that is that especially when it comes to fleet ownership, it's highly fragmented. And what that means is that you, even let's say, as we are moving from intra-city to intercity buses. Intercity buses is almost entirely private sector, and the fleet owners typically have 5 to maximum 20 buses or something like that, which is, we have very fragmented markets. Similar is the case with trucking. In Africa, if it is two-wheelers, it's an individual. So for an institution like ours, which is not into retail banking, we don't have a retail footprint. So we work very extensively with other local banks and financial institutions in the region to on-lend to them, who can then provide capital to such kinds of opportunities. But then, as you can understand, that it brings a lot of concerns around the off-taker quality. So the bankability of the off-taker gets added on to all the other risks around regulations, around technology, resale value. And for a bank to wrap its head around resale value for a completely new technology product where there is no liquid resale market, it becomes quite challenging. So I think for us, the next frontier of growth, I mean, we would continue to build investments into good quality companies who can be asset cos, who can own assets and provide it as a service. But I think if you really want to push the envelope and get it to a very large scale, we would need to bring the banks on board into being able to do this financing for the MSMEs who are involved, And that requires other kinds of potentially de-risking instruments, as well as engagements and project development support and a host of other kind of interventions that you would need to think about. So that's for us the next big North Star that we want to look at. Thanks.
I think and the next frontier is, we're talking about the importance of, certainty in any kind of transaction and deal, and at the same time that the next frontier is going to more fragmented markets where there is a need of resolving other elements of kind of that relate to that market fragmentation. So that's a really interesting point. And then I think that there was and this is an open question more to who of you would like to talk about. We started seeing kind of pilots, right? And when technologies start developing, there is kind of this, okay, let's pilot this technology, and kind of some of those pilots then have kind of achieved a scale. So anything about structural contractual features that you're seeing, comparing kind of large fleet developments versus pilots, and then the risk associated with that? Anything around that kind of large scale versus pilots, and any lessons learned from pilots implementation?
I mean, happy to start from a bank perspective. I mean, pilots are what it says, pilots. So usually you don't expect them to be big in a financing size. You expect them to be not necessarily having the latest proven technology. So it's a bit of dipping your toes into it and trying actually to be in a sector and therefore in a product that you think has scale to grow. Otherwise, you would not necessarily, from a lending perspective, enter into a pilot project. I think what for this sector is also very, at least from my perspective, typical is it should not be seen as a short-term lending or a short-term sector. It's a long-term sector. So the growth is really not to be expected in 1-2 years, but actually further down the line, because we all know it's there. And I think a lot of these pilots are important, and I think a lot of the pilots have really driven the whole sector move forward, and therefore where lenders can get comfortable, and a lot of Kartik and Jeff have mentioned, it's usually if you have good sponsors behind, a very good management that knows what they are doing, if you have data like Steer providing, which are not overestimating certain growth expectations, or else it's hugely important to start pilot projects, and then any pilot can become a bigger project by default.
I'll add on to that by sort of shifting the question, because I think Julie answered that well. What about going from, you have a pilot into smaller scale commercial size? What about getting from smaller scale to larger scale commercial size? As a question. Everything we've been talking about is, scale, sponsor, business model, moat, but there's not a lot of companies out there that have 5 years of cash flow history or 10 years of operating history that shows stabilized, predictable data. So, I think that comes along with scale, but really to go from sort of like the market's kind of gone from pilot to where it is now, and then there's these growth curves that are somewhat bankable, but really to sort of take that giant leap forward, I think is just going to be being able to look at historical financials and operational metrics versus looking at forecasts. And in the meantime, I think it'll be sort of taking one step at a time. And once we're there, I think it could, I don't know whether that's 2 years from now or 5 or 10, but once you're there, I think it becomes much more mainstream traditional financing.
Thanks. Kartik, any comment on that?
I think I just amplify the point that Jeff just mentioned. For us, when I mentioned that one of the challenges for us is dealing with fragmented off-takers, it comes also with the fact that they are relying on uncontracted revenue. So the two almost go hand in hand. and therefore that risk profile really gets amplified, and that's sort of what we need to look at. And again, exactly like Jeff said, so we need to look at what amount of historical data is there on revenues and so on, and look at whether we can get comfortable, whether our banks can get comfortable, and figure out ways to potentially have some kind of a de-risking mechanism in between to get that going.
Yeah, thank you for that.
And I think Karthik sort of referenced it. The other way, besides waiting for sort of maturity of stabilized cash flows and operating history, is just a bona fide contract with a strong counterparty that is sort of de-risking it for you. That's another way, but hard to find.
Yes. Um, Good, an interesting conversation, and I'll get to the bonify concept of that kind of as a potentially, an additional kind of a structure that we haven't discussed a lot in the past. But then let's move on. I think we have questions from the audience about heavy duty vehicles, trucks. There was a little bit at the introduction and the start of the conversation. So mindful of time, let's talk, more about the question, and then each of you can add your perspective in terms of how financeable the conversion or evolution to heavy duty vehicles is today, where we are, what conditions need to be met for them to, attract that private capital. Structures, financing models, lessons learned to share. Karthik, you've mentioned that trucks in your introduction. So more of a free conversation about heavy duty and truck fleets. Would like to go first? Karthik,
Okay,
maybe
yeah,
go
I
to you.
can just briefly touch upon this. So what we are observing is that obviously if you look at heavy trucking, long haul heavy trucks is not something that is immediately the short term very financeable because of obvious reasons. You need the infrastructure in place, the operating attributes, and so on. And also, in our markets, we see that in the absence of long term contracts, these trucks, a lot of them operate on spot markets, which then makes the operations even more challenging. They are not always going to be running on the same corridor where you have infrastructure. So they may do one trip where there is charging, but then they may want to go somewhere else where there is none. So long haul heavy trucking is not what we are actively looking at. We are trying to work our way through that. But what we also see is opportunities where there are niches where they're not niches, but they're in terms of volume, they're substantial, where there are fixed route operations. So one of our investee companies operates trucks for the cement industry, where there is a fixed route of operations between two start and end points, and reasonably long contracts, and they're able to match what the diesel prices are today, the diesel truck prices are today on an operating basis. So there is a commercial viability and an operational feasibility. So the two things need to go hand in hand. Then, of course, you come with the bankability of the off-taker and the contract. So those are some of the key things that need to fit into this. So this is something that we are starting to see pockets of it in the heavy trucking space. All the other trucking investments that we have in Latin America, Mexico, and Brazil are with the light duty trucks. So they are more intracity, last mile delivery, those kind of operations. So they are not in the heavy duty space. Thanks.
Yeah, I can only echo what Kartik said. And as mentioned, I think at the beginning when we started, I think the challenge for the heavy e-trucks is really the charging infrastructure and how this is going to be built out and financed. I think we potentially might see it first emerging more in Europe, given the focus of the European Union on really building out safe charging infrastructure across and ensuring this. So we might therefore see an uptake, but I think until then, as outlined by Kartik, we will see more of those where you have a fixed kind of range of these travels in which you have that ability to charge and not yet in the long distance.
Yeah, I wouldn't have much to add that hasn't been said. I would double down on Kartik's comment about sort of that closed loop route system. You know, I don't think I've seen too much of them, but those are the types of deals that you can really believe in the forecasting. You know, like for example, we're always looking out for you know, seaport maritime terminal charging situations in the U.S.
Exactly.
As sort of like maybe like the first step to more fleet electrification in the U.S. because I think the U.S. is behind.
So very
And it's
interesting.
also like a different question not being asked is like, you know, all the other things that have to happen around policy and capital markets, and you know, thinking about the U.S. is like, you know, all the electricity demand for industrial electrification, mobility electrification, AI, and data centers. You know, what is the, you know, all the cost of the battery, the value prop, and I think that goes to, you know, we're talking about heavy duty vehicles versus other. You know, I think the savings case for a large corporate will implement a large strategy quicker than U.S. consumer adoption. Um, I know we're talking about fleets, but I think all of that has to do with sort of how AI and power gen and capital markets digest everything all together all at once.
Definitely. Thank you. And I think we have time for one other question from the audience, and then perhaps reflections to close the panel. An hour has gone very, very fast. So the question is about the role that carbon finance can play in financing low emission fleets in the next 5 years. Is there any of our panelists that would like to respond to that question from Luis Chaparro?
Was the question saying carbon finance? Is that the question?
Carbon finance, yeah. Yeah.
From speaking from an institutional investor lender's perspective, we typically aren't leveraging against the monetization of, say, carbon credits, especially in the US where there's no market. If there is some sort of captive carbon tax or credit market, that may be different, but we see that more of a equity upside and should be baked into an M&A equity base case rather than a senior lender's base case. Being honest.
Thanks, Jeff. Well, as I was saying, 1 hour has gone very, very fast. It has been a fascinating discussion. And I'd like perhaps to go to each of you for a few minutes of kind of your reflections, thinking about wrapping up our conversation today and all the different comments we have or points that we have talked about the market, the structures, the enabling conditions, scale, and then the types of vehicles. What are your closing reflections and the one message that you would like to leave to our audience? So perhaps I start with Julia.
I think the closing comment for me would be it's definitely a market that will grow in the next years to come hugely, and it has a lot of potential. What I would say is also that in the sector itself, we will see a lot of, and I use the word fragmentation not in a negative way, certain vehicles, like we said, buses, vans, and else, will not grow at the same pace and not provide the same opportunities at the same time, but they will all at certain points in time give these growth potential.
I'll save the best
which
panelist for
therefore
last.
makes it really actually.
Oh yeah, we're losing Julia, unfortunately.
Sorry,
Julia.
Sorry,
we lost you for a second. If you wanted to finish your thought there.
Sorry, no, I just want to say I think what we will see is really the growth potential in the sector mingled with the overlap in the other sectors. So I really am looking forward to see how it will merge with energy, AI, and else. And
Yeah, continue having.
So
We should go to
if
Jeff.
Julia comes back, I'll pause. I'll echo what Julia's point about the interesting of the overlap of sectors. You know, like I think here today, I think it's interesting how 5 years ago, there was like this exuberance, and here we're a little bit more sober. And I think that's probably a good place to recalibrate. As you know, I think in the state we're in today, there's also the sort of geopolitical, different policies and different things to consider, which is kind of a headwind. But the tailwinds are that, the cost of batteries are going down, the business case is there. So I think things are picking up in that regard, medium term. And then long term, again, the overlapping of sector is long term. When autonomous vehicles in fleets come in, that's when everyone will want to go electric 100%. So get ahead of that trend.
Thanks, Jeff. Kartik.
Yeah, I think my closing remarks is more as a reflection on us as an institution of how we need to kind of expand our footprint in the space. So clearly, I think I totally agree with Julia and Jeff that the opportunity is growing and it is going to be large. It is already quite large. But in our markets, we also need to strengthen that portfolio approach of the kinds of instruments that we deploy. So I think that's where we need to sharpen our toolkit in terms of the kinds of instruments. I mean, there are countries we are engaged in policy advisory to help the government get the policy framework in place. So it starts right at there. Then sector advisory, company advisory, early stage investments, risk sharing facilities, payment security mechanisms. So it's not just a classical equity debt kind of a question for us. It's like an all of the above approach, and how do you build that muscle internally to be able to work with much more, many more countries that are now coming into this sector in a rapid way. So that's our challenge to take back and work on.
The toolkit, yeah. Well, a special thank you so much to you all, our panelists, for the time today, for sharing your experience, being so kind with your knowledge and your learnings to our audience, also to our team. And there was a lot of people, behind the scenes making this happening. And the recording will be available after the session, so please do share, and people will be able to kind of play with languages and closed caption and all that good stuff. So if you'd like to explore these further, there are emails of the Steer team, and then Flindley, I imagine with the panelists you can connect, and LinkedIn and other platforms. And please stay tuned. We will have certain publications coming up soon, and more reflections and spaces like this. And with that, we will bring that session to a close. So thank you all, and have a very good rest of your day.
Thank you.